tonight. By the way, I'm sure you guys are well aware that next week we do not have class. My dog's birthday. We get that off every year. So next week we do not have class. So this is what we're going to cover tonight. We're going to start in on Chapter 9 handout. And Chapter 9 problems, PR 2A and PR 9 2B. We may not get through both of those, but we'll see. Okay, so let's go ahead and just jump in, I guess. All right. I gotta pull it up here. Okay, you should have this in your email, or I believe. It's in the class handouts also. Now checking, because I can't remember if I put that in yet. I did. See, you guys shouldn't have doubted me like that. Just because it's happened 30 other times doesn't mean all right. So we're talking about depreciation. And when we talk about depreciation, we're talking about for long-term assets, things that last for more than a year. You do not depreciate things like inventory or things like that. Office supplies or anything like that, but things that are for long-term, equipment, buildings, those sorts of things, you depreciate those. What we mean by that is you say, okay, we paid all this money, but it's going to last us for several years. So we try to do what they call allocate, how much goes into each year. So if you pay here I got the example of $800 for a machine. So if you pay $800 for a machine, you say, okay, well, I'm not going to expense that all this year because I'm going to use it for many years. So I'll expense a little bit, this cost. I'll spread it out over the life of the thing. And that's really all it is. You're just trying to take this cost that you have in this long-term asset and say, okay, well, because we're going to use it for many years, we'll cut up the cost for many years. Okay. So for instance, if you paid $800 for a machine, so you pay $800 for the machine and it has a life of 8 years. Say, okay, well, it makes sense if we split that up over the 8 years. So we'd have $100 each year. For depreciation expense. And that's where this comes in. I know this is a little bit repetitive, but so every year, excuse me, we say, okay, well, we're going to split this cost up because this is going to last for 8 years. Every year, I'll get $100 worth of it. And at the end of 8 years, this is going to be worthless. And we will have it all, all expense. Okay. Now, the one that's a little bit trickier is the second one here, and that's the accumulated depreciation. So this accumulated depreciation is kind of like this. The first year, it's the same. Accumulated means it just adds up, so it accumulates. When we get to the second year, we have the first year and the second year.
Making 200.
Yep. And third year. So you can't get the idea that it just keeps adding up until at the end, it's going to be accumulated depreciation. So here's what's going to happen at the end of this thing. At the end of this thing, you're going to have the equipment for $800 on the books. This accumulated depreciation, which I don't know if you guys recall, but it's a contra asset. It goes against the asset. It'll be for $800. So it'll be on the books at zero, which is what we expected to be at the end of the 8 years. So the account itself, the equipment account, will have $800 in it. The accumulated depreciation will have $800 in it, and won't be anything left. Okay. All right. So book value, carry value, net value, basis, that's a tax term. These all mean the same thing. It's what is this thing really worth? And it's the asset cost, whatever you paid for it, minus all the accumulated depreciation. Okay, so if we go to 2023, bold it. I've got my spacing. Okay, I'll unbold that. Okay, so we go to 2023. The cost of the asset was 800. The accumulated depreciation was 300. So the book value or net value would be 500. And you kind of know that. I mean, if you've had it for 3 years and it's $100 a year, you could take off $100 every year, right? So the book value of this would be $500 because you've depreciated 300 of it. Make sense?
Yeah.
Kind of a weird thing. I think accumulated depreciation is kind of a weird thing, and I think we talked about this before.
Yeah, a little bit.
Yeah, I talked about it. Well, I'll talk about it again. I don't mind boring people. Yeah, I'm good at it. Do what you're good at. Okay, so that's the kind of how the book value comes about. Where you'll have it on the books at.
So we have this in the email, right?
It should be in the email. If not, it's in Blackboard.
Okay.
Under documents. No, not documents. It's got class handouts. I usually call it course documents. So if you hear me call it that, it's because I'm old and confused. All right. Okay, this next some of the stuff's kind of terminology. Residual value. And the residual value is what's left over at the end of the life of the asset. How much is it worth at the end? So if we're going to have it for 5 years or 10 years or whatever, at the end of its life, it might still be worth something, or it might be worthless. It's possible you just wheel it outside and hope somebody takes it. But so the residual value is what you expect to get back at the end. Now, it can be called a number of different things. Scrap value, that's probably the most popular one you're going to see. Salvage value is the most popular one you're going to see. But there's also scrap value, terminal value, ending value. These are all kind of the same thing. They say, okay, what's this thing going to be worth at the end of its life? Okay. I just said that down here. Okay. Now, residual value will reduce the cost of the asset. For example, if you paid, let's go back to the other one. If you paid $800 for the machine, if you had a residual value of, say, $150, well, that's money you're getting back. So it really doesn't cost $800, right? It's only going to go down, you're not, the cost of it's going to be 800 minus the 150, whatever that is. So the residual value will reduce your total cost for the asset because it's money you're going to get back. You pay out money for the asset, but then at the end you get something. Okay. Depreciable amount. How much is the truck going to do, or whatever asset it is, how much is going to depreciate over its life? And we do that by saying the cost minus the residual value. Because the cost is what we're paying out, but this residual value is money we're going to be getting back. So if this is a truck. Yeah. So this truck, we plan on using it for, well, it doesn't say how many years. What this crummy handout. So at the end of its life, when we use it for however many years, it's going to be worth $4,000 that we can sell it for $4,000. Okay, well, so we're paying out $20,000, but we're going to get back cash of $4,000 when we sell it. This residual value is what we estimate we're going to sell it for. So we're really only going to depreciate this thing by $16,000 because it's really only going to go from $20,000 down to $4,000, right? So it's really going to just decrease by the $16,000. Okay, and this is one I talked about before. I'm positive I did. I think I used the same numbers even. Why do we use an accumulated depreciation account? And it's because of this. It's very reasonable for someone to say, well, why don't we just look? When you expense something, forget about this accumulated depreciation account. It's a pain. Just reduce it, take it right out of the asset. If this is a machine or equipment, whatever, just take $100 out of the machine account. Easy. The problem, not the problem, the idea is though that the actual cost of what it is can make a difference. So you would have if you had these two pieces of equipment, you just looked at the book value, they look the same. Equipment A and equipment B are both worth $5,000 on the books. It'd be absolutely normal to assume that these are very similar assets. Where if you had this extra information though, so for instance, which of the above pieces of equipment is the most expensive to replace? What would it be? If you had to replace equipment A or equipment B, which would you be the least happy to have to replace?
A. Oh no, B.
No, you got it right first time. A. Yeah, it's more expensive, $125,000.
That's expensive, so it depreciated more.
Exactly. So this is
B should be easier to replace than A.
Yep. How weird. It's going new time. I gotta figure out why it does this. Every now and then, it just starts going to New Times Roman, which I have not even seen in years.
So A is older.
Yep. You're right and right. So equipment A, which is older, A. And here's the problem with that. A is a really expensive piece of equipment and it's old. So if you were looking at this, if you're a manager, your manager looking at the financial statements, you look at this and you'd see, whoa, this one, it's very old, most likely. It's really, depreciated, and it looks like it's a very expensive piece of equipment. So we're going to have to pay out a lot of money very shortly for equipment A. Compare that to equipment B, it's depreciated a little bit, but not much. compared to the original cost. And it's way cheaper, at least relative to equipment A, it's way cheaper than A. So, you get a little bit more information out of it. And that's why we have this cumulative depreciation account. We're always trying to give as much information to managers so that they can make good decisions. And that's one thing about accounting is you're trying to get as much information for them to use as you can. So the reason why we keep this account, cumulative depreciation account, because it gives more information. Okay. We're going to go through a couple of different ways of doing the depreciation. There's more ways than I'm going to show you, but these are probably the most, A, they're the most intuitive ones, and B, they're the most used ones. And we have a straight line method and a units of production or units of activity method, which we'll talk about afterwards. Okay, so let's see how this works. A truck was purchased for $32,000 on January 1st. So beginning of the year, we bought this truck. It has an estimated residual value of $8,000. So we're going to sell it for $8,000 at the end. That's what we estimate anyways. Let me start highlighting some of these things. And it has a useful life of 5 years. So we think we're going to use this for 5 years. The straight line, down on the same page. Same line, I should put. Straight line method of depreciation. Okay, and I'll tell you, we'll talk about why this is. Okay. So what we're going to do is figure out how much is this thing going to go down in value? How much is it going to decrease in value?
32 minutes. It is going to be 24.
Yep. Sorry, I'm goofing up my screen. Okay, so we're going to find the depreciation expense. Okay, so we have a cost, 32,000. We have a residual value. So we're going to get back, we're going to sell it for 8,000. So it's going to reduce our cost of it. And this will give us our depreciable cost. And like you said, 24,000. Okay. We throw some. So this is the residual value. Okay. So this is what's really going to go down. It's going to go down from 32,000 down to 8. It's going to decrease in value by 24,000. Over what length of time is it going to do that?
Over 5 years.
5 years.
5 years.
So we're going to divide that by 5 years. Wrong. Let's try that again. Okay. And that equals some number.
4,800.
4,800. Thank you. So this would be the depreciation expense.
For 5 years.
Yep, every year for the next 5 years.
Next 5 years, okay, until it's exhausted.
Yeah, exactly. So this would be the depreciation expense per year. I'll just leave it like that, make it more confusing. Okay. So the year end. This will be our depreciation expense. That's spelled like that. And accumulated depreciation, and it's going to be for 4,800 every single year. So same thing in 2022. And so we're just going to make that same journal entry every year for the next 5 years. So every year it'd be exactly the same for this method.
Yeah. Okay.
Okay. Now for the really, really confusing part.
Mhm.
Right, what is this thing? The truck? I would probably call it. You could call it truck too. That's fine. All right. I'm gonna bold these so we can see them. All right. So the equipment, we paid 32,000 for it. And that's going to be the same every single year. That will not change. Okay, the depreciation expense. So let's say the first year, 48.
4,800.
Now the
Next
first
5 years.
Yeah, the first year, these would be the same though. The first year, the accumulated depreciation, because we've only had it for 1 year.
Mhm.
All the years so far, it's just one. So this will be 1 year. So the book value will be the equipment. Let me see if I can do this crazy one here. Ah. Okay, so we're going to take the equipment account minus
27,200 minus the depreciation.
Mhm.
27,200.
And that way, that will give us.
Depreciation. So each year's gonna keep going down the value. Minus. Okay.
Wait, I didn't. Hold on. 27,200, you said, right?
27,200.
Okay, so this will be our book value. All right, now we go to the next year. This is where it gets a little bit tricky. Now, the accumulated depreciation is everything up until this date. So how much would be in our accumulated depreciation as of year 2?
Gonna be 4,800 times 2. So what's that? 9,600, right?
Yep. Oh, that's not.
So 9,600 subtracted.
Yeah, and so this is just these two. You know, these are the two depreciations we have so far. So those two added up will be 9,600. So this will be 3,200. Excuse me, 32,000 minus 9,600. It's what, 22,400 maybe?
22,400, yep.
Putting dollar signs.
So now we got a triple.
Yep, and the same thing, you know, as you probably have picked up, this is going to be the same every single year. Okay, so year 3, now we have 3 years.
Right. So it's gonna be 4,800 times 3?
Yep.
14,400.
400, thank you. So 32,000 minus 14,400 equals some number.
30,560, I believe.
How much?
13,560. 32,000 minus 14,400. No, it's less than that, right? Let me see, 32,000, 17,600, 17,600. What I did.
Notice something here, though. You see that this equipment account just sits there. Yeah. Now these are getting added every year, but the equipment account just sits there like a slug. Okay, so after 4 years,
19,200.
Yeah. Then that's minus 32,000 minus 19,200. 12,800. 12,800. Yes. This is gonna be 5 months, 5 years, 5.
and these two numbers,
24,000.
no, it should look more room here. These two numbers are this 24,000. This is the depreciable amount, and this is the residual value.
Residual value.
Yeah, so how much you're gonna depreciate? 24,000 in total. That's what we did. And
Mhm.
then how much is it gonna be left at the end? 8,000. So this, let me write this. Let me see if we can add a row on here. Okay, so this will be the depreciable amount, whatever that came out to be. And this one will be the residual. You know, you expect to go down to 8,000, and that's what it would be. All right, let me give you 1 second here. There go the doggy cam. I just want to kind of show you why they call this the straight line method. This method is, well, first of all, I think this one's probably the most intuitive one. If you never see, you know, if no one ever told you anything about depreciation, you probably come up with something very similar to this. Okay. And stop sharing for a second here. It's sort of like this. So 1, 2, 3, 4, 5. So this will be 2021, 2022. Okay. So it's sort of like this. This thing starts out at 32,000.
Mhm.
So this is the book value. At the end of the first year, it goes down to some number, 27,200. And until by the time it gets all the way down here, it'll be at 8,000. So it sort of looks like this.
Straight line, huh?
Exactly, that's it. It looks like a straight line.
Wow.
If you charted out the carry value or the book value, you know, every year it goes down by 4,800.
Yeah.
So every year, you know, this goes down to, oh, I forgot, right, 27,200, I think it was.
Yeah. Then 22,400. 17,600. 12,800, and then 8,000. You got that already.
Yep. So every year it's dropping by, it's going down by 4,800. So it look like, if you charted it out, it would look like a straight line going down.
Mm-hmm.
So that's what they call it. Every year it takes off the same amount.
Wow.
Okay, let's go to page 4, problem 4. And I tell you what, I'll be quiet as I can, and see if you can figure this one out. Now, when it comes down here to the end, this thing's going to last for 10 years. We're not going to do 10 years. Let's do the first couple of years. We could do 10 years, but it would just be, you know, a little bit tedious. So, you know, all this stuff is similar to what's on the previous page. Numbers are changed. So see if you can figure this one out. Okay, I think you should have gotten 8,000 per year.
Yeah.
So far it looked like this.
Mhm.
Coming down here, asset cost 120,000. Let me bold this whole thing. Equipment. $8,000 coming off each year.
Mhm.
The cumulative depreciation first year would be the same.
Yeah.
Next year would be 16.
16,000.
So book value would be
112,000.
104.
Yep. Alrighty.
Okay. And so this would be so minus. Hey, how come I have minus symbols? Okay, and yeah, so you're gonna take, I'm just gonna use use arrows. Oops. So you're gonna subtract out the cumulative depreciation, and that will give you the book value. Okay, I got a confession to make. I'm not really very good at making graphics, but okay. So in this depreciation, accumulated depreciation, this will eventually go down. This will be the depreciable amount at the end, and this will go down to the residual amount. Okay, I tell you what. Let's take a break now.
Okay.
Then we'll go to. There's another method we're going to cover. And we'll. So be back at, look at this, it's going to New Times Roman. Why does it keep doing that? I must have cut and pasted something in there that was Times Roman many moons ago or something. It's like a ghost, it keeps coming back. Be back at what, 6:48?
7 o'clock.
Very good, 7 o'clock.
Thank you.
This whole thing looks like it's Times New Roman. Why? to A, yeah. Okay. Well, the next thing we're going to do is a different method called the units of production method or units of activity method. And it's there when you use an asset, but not for the same amount every year. So straight line method, if you have something that you use pretty much the same every year, it's fine. You know, so split up over the number of years because you're going to use about the same every year. But there's some things that you don't use the same every year, like a snow truck, a snow plow. You know, that some years we get a lot of snow, some years we hardly get any. So if you had a snow plow, there's some years where you're going to use it a lot. There's some years where you're hardly going to use it at all. And so the idea is, well, those years that we are using it a lot, we should depreciate it more. It's going to have more wear and tear on the equipment. Those years that we are not using it, you know, very much, we shouldn't, because it's not being worn out those years. And two, the years you're using it a lot, you're probably going to be billing a lot, right? I mean, if you're using that plow on a lot of parking lots or whatever, you know, that you're probably going to be billing much more, and the expenses should match up with that billing of what, you know, what you're actually using it. So that's kind of the idea behind this units of production method. This can be called any number of things. It's a reduction activity method. This is a units of activity. Sometimes it's called the activity method or production method. So these are all the same thing, and different books and people will call it different things, but they all mean the same thing. It's where you don't use years. You don't use years. You use whatever the life is going to be in how much this thing is going to be used. So for instance, if we have a truck here that was purchased for $32,000, oh, this is the same scenario. Residual value is 8,000. We've seen that one before too. Now, this useful life, instead of saying that this truck is going to last for 5 years, we're saying this truck is going to last for 100,000 miles. So we have to depreciate it over this, you know, these miles that we have that we're going to be using for this thing. Okay, so, and we'll use these later on. These go with that. Okay, so coming down here, it starts out exactly the same as we did for the straight line method. Okay, so we have our cost, 32,000. We've all seen this one before. What's going on here?
$24,000.
And so up to this point, it's the same as a problem 3.
Mm-hmm.
So this is a depreciable amount.
We're gonna divide that.
Okay, now here's where it gets a little bit tricky. We're not going to use it. We're not going to put in how many years we use it for. its useful life is not in years, it's in
Now,
miles. Okay, so useful life amount. So here's the question. How much are we going to depreciate per mile? If you think you have the answer, either yell it out or put it in chat.
are we dividing? Are we dividing? It's
Yep, yes,
24,000,
100,000.
right? Came out to 0.
Yeah, 0.
416, 416.
No, no,
No, wait a minute, 100,000
No, no.
divided
other way around. 24,000. These are the dollars.
24,000.
Where did you put these in? These are dollars.
The 0.24, I don't know.
Yeah, is it? Or 24 cents a mile. Yeah.
Right, 24 cents.
And by the way, this is what you for taxes. This is how they do it. This is per mile is the usual way that you do that. Okay, so now we know how much it is per mile. So now we have to wait for each year to come around. And however many miles they had, we'll use that for. So for instance, okay, so first year we use it for 10,000 miles. Oops.
Then double it up each year like we did before.
Well, no, not yet. We're just gonna put these.
Or different.
Yeah, they're gonna be different amounts. Those will be 2,400, I think.
Right.
This one I gotta use Mr. Calculator for.
55,000 times.
So these will be the amounts that will depreciate each year. So this will be our depreciation expense. Each year. And if you look at this, you notice that it's, the amount that they use it is quite different every year. First year was only 10,000. Second year, 55,000. So you use a lot. Third year, 35. cut back a little bit. So it would make sense to actually use this method because you're using it a lot more in some years than in others. And notice that in this year, you probably also made a lot more revenue on this thing, you know, because you put a lot more miles on it. So, okay. Journal entries. I'm going to show you how to cheat. It's a very important skill you should all have. Cut and paste all the way down here. Oh, don't do what I just did. Let's try this again. There we go. I guess I'm not very good at it. You're on your own. Okay, so 2,400.
Okay, just doing the first year.
And the next year will be 13,000.
Yeah. Okay, that's it.
So this method, you will get different amounts, or it's possibly get the same if you use the same miles, but oftentimes you'll get different amounts for. And by the way, you know what you just do is someone goes out, you know, at the end of the year, someone will go out and look at the truck and see how many miles are on it. So the first year they'd be 10,000 miles on the truck. Second year they go out and there'd be what 65,000. You know, it'd be how many more miles do we drive? So it'd be probably 65,000 on it. You know, and that's like how you come about with how many miles you drove this thing. Okay, coming down here. Ooh. All right, the asset was 32,000. That'd be the same every year. Depreciation expense 2,400 and 13,200. And for your 2023, it was like 8,400. Okay, so let's take a look here. So these are equipment. Accumulated depreciation. First year would be 2,400. So first year about 29,600. You want to check these numbers. Okay, accumulated depreciation in year 2 would be 15,600. No, 16,400. And down here, this will equal 24,000. And again, this will be the depreciable amount.
Just a residual. Depreciable.
Yeah, so this
Okay. This minus.
depreciable amount is 24,000. So the cumulative depreciation is going to be the same as that depreciable amount at the end. By the way, I'm sure some of you are wondering, well, okay, these are estimates, right? And we don't have a crystal ball. We can't tell what's going to happen in, tomorrow. But I mean, certainly not in 2 years, 3 years, 5 years, whatever. And you make, you find some way of coming up with an estimate for it. If you've done this in the past, what did these machines sell for? It was a truck or it's a truck, right? Okay, what did we sell when we were done with the truck? What did we sell it for? What percentage of the dollar do we get back? You may even talk to the dealer or whatever and say, what was this going to be worth at the end of its 5 years or whatever it is. So you're trying to come up with an estimate. Now, the estimates are not always accurate. They can't be. One of the myths is that accountants have crystal balls and know how long something's going to last. We could look into it and gaze into the future, and we can't. So one of the things that, if you do find out that your estimates are off, let's say they're off something a lot, you think it's going to last for 10 years and it's really only going to last for 5. If you do find out that something is off, you do not go back and change the financial statements. So for instance, if in 2023 you found that something was off, you say, oh, wait a minute, it's going to last for, whatever, however many miles, 200,000 miles. You don't go back to this year and recalculate it. When you find that the estimate is off, at that point in time, you go, okay, we're going to plan now for this new estimate we have, but going into the future. We're not going to go back and change the financial statements. This is the best information we had when we made them, and you don't change those. And you can imagine that this could, you would just be changing the financial statements all the time if you have changed these estimates. So if there is a change in the estimate, you stop at that point in time and say, okay, going into the future, now we're going to work on if this truck is going to last for 200,000 miles rather than the 100,000. Or whatever the change is. Question on that thing? Okay. Well, if there's one thing I know about college students is they love doing depreciation problems. So number 6 is here. And I will be quiet. And see if you can figure this one out. Okay, I think you should got 16,000 and 24,000 depreciation.
Yes.
And down here,
Assets.
Mm,
so I think it's just something that looks like that. Any questions? It sounds like R2D2. R2D2 has a question.
Notification.
Oh, okay. Okay, so the cumulative depreciation, so the second year we add up the 16,000 plus the 24. So the total we would have written this down by was 40. So 120 minus the 40. Oh, here's the one I should be using. Okay, so this is so those are the two methods that we're going to use. There's other methods out there. These are the two ones that are used most commonly. Straight lines used by many companies, if not most, and the production methods also used, or the activity method. There is a method for taxes. If you do your taxes, that you can depreciate some things for your business, and those are basically these are a method called the low declining balance method. There's variations of it, but it depreciates things a lot more up front. And for taxes, that's a good thing. You know, in real life, you want to have income. You want, the more money you make, the better. When it comes to paying taxes, it's just the opposite. You don't want to have any money. So one of the ways that the government encourages people to keep buying equipment, reinvesting in the companies, keep these companies going, is to give them generous write-offs for buying new equipment. And so when you buy new equipment, you get to depreciate a bunch of it right up front, which reduces your taxes. The government is not terribly interested in your real income. You know, they use the income tax tables and stuff like that for also to encourage activities and discourage other activities and so on and so forth. So they're trying to encourage people to to buy more equipment, and keep the economy going and all that kind of stuff. And speaking of this, there is something about depreciation expense that is different than most of your other expenses. You know, what's the difference between depreciation expense? Look at this journal entry: depreciation expense, accumulated depreciation. Let's say that you're paying rent. You'd have rent expense. So let's say you paid your rent for the month. You'd have rent expense, and what would be the other account? What do you pay your rent with?
Cash.
Cash. Notice something about this entry. There's no cash. You hear about paper losses. People say it's paper loss. You know, they really didn't write it. This depreciation expense that you have on the books, 16,000. There really wasn't any cash going out for 16,000, right? Now you did buy it. When you bought it, you paid whatever for it. But these expenses are, you know, what they call paper expenses, that there really wasn't any cash going out. So notice the beauty of that if you can write something off, make your income look lower, but not pay any cash out, you know, that's a huge benefit. I owned a 3-flat in Wicker Park for a while, and the first year I lost $11,000 on taxes. Yeah. There are paper losses. There is a depreciation. You know, you buy a building, or a rent or whatever. You have appliances. You have refrigerators, stove, you know, washing machine, dryer, all that kind of stuff. Those all get depreciated, even though, you know, they were in the building when I bought it. At least most of them were. You get to write all those things off, and there is no cash going out for it. You know, the cash is not necessarily leaving you. So that's one of the nice things about things like real estate. If you're wondering why people and how they make money in real estate and that kind of thing, a lot of it's because of this, because they can write off things that they really aren't paying cash for. All right. You know what? We're not in class next week. I'm gonna call it a day.
Thank you.
Thank
Good
you.
night.
Thank you.
Good night.
Okay, so
Seriously.
everyone just disappears. All right. Well, I will see you guys in 2 weeks' time. We will meet up again.
Okay.
All right.
Thank you.
Thank you, Professor.